Welcome to Accounting with Damien educational video IAS 37 Provisions, Contingent Assets and Liabilities. This video is produced specially for the students of a degree professional qualification like CIMA, ACCA. This video is also beneficial to anyone who needs to get a basic understanding about IAS 37 Provisions, Contingent Assets and Liabilities. What you will learn in this video is what is a provision, IAS 37 guidelines, detailed explanation on the 3 conditions to be satisfied, accounting entries for provisions, contingent assets and liabilities, and disclosure requirements.
Hi, I'm Jonathan. I used to work in a construction company. I was asked to work on a scaffolding without the proper health and safety equipment. I once fell off this scaffolding and I damaged my spine severely. Now I can't do heavy duty work anymore. I asked the company to compensate me and help me out, but they refused. They blamed the entire incident on me. The only option I had was to seek the assistance of the law. Now I'm suing the company for $400,000 to cover my medical expenses and also other damages. Hi, I'm James. Jonathan used to work in our company. Our legal team has looked into this matter and it is our fault because we did not provide the appropriate health and safety equipment. We have arrived at an reliable estimate that this would be $300,000 in compensation. This court case has been going for months. We are not sure when this would end and how much we'll have to pay. We accountants need to be cautious when we prepare financial statements. The prudence concept asks us to do so. We should not overstate our assets. We should not overstate our income. We should not understate our expenses. We should not understate our liabilities. Now the $300,000 the company needs to pay Jonathan because it's probable that the company will lose the case, which means this was an expense, this was a loss that the organization had to incur in this financial period. So you should reflect this in your financial statements. Therefore, we create a provision for that expense and we debit the provision expense account. And we have an obligation to pay $300,000 to Jonathan. So that $300,000 is a liability. So we are recognizing a liability. We credit the liability account to reflect that in our financial statements.
According to IAS 37, to recognize a provision, there are 3 conditions that need to be met. The first condition is that there should be a present obligation due to past events. The second condition is that there should be a reliable estimate on the cost. The third condition is that there should be a probable outflow of economic benefits.
So we are looking at whether do we have a present obligation due to a past event. Now guys, an obligation can be created in 2 ways. One way is a legal obligation. Like in the scenario that we looked at, health and safety regulations is a legal requirement. Every construction company needs to provide this health and safety equipment, right? Failing to do so will result in financial penalties at the court cases. Then guys, the second type of obligation is the obligations that we construct. We call them constructive obligations. Now, constructive obligation is like you put in a sign saying that I am going to refund to your goods and services if you do not enjoy it within the next 30 days, right? You might have seen few fitness companies that come up with advertisements saying, you buy this equipment from us, use it for 30 days. If you don't have any results, we'll pay back the money, right?
So these companies are creating a constructive obligation. Okay, right. Smith Limited year end is 31st December 2007. In November 2007, they dismiss an employee. In February 2008, a customer slipped while on their premises and breaks a arm. Okay, so on 31st December 2007, right, you have a dismissed employee, and then on February 2018, February 2008, right, you have an injured customer. In March 2008, both the employee and the injured customer sue Smith Limited, the former for unfair dismissal and the latter for compensation for injuries suffered on Smith's premises. Should an obligation be considered as at 31st December 2007? Right? Now guys, this incident occurred where the customer was injured in 2008. Your financial year end is 2007. So as of 31st December 2007, the incident had not occurred. Right? So as of 31st December 2007, Smith does not have a obligation. The past event has not occurred. But when you look at the employee's dismissal, the employee was dismissed in November 2007. Right? Now November 2007 belongs to the current financial year. Right? So here a present obligation exists due to past event. But however here no present obligation as at 31st December 2007 since the event has not occurred. Right? To arrive at a reliable estimate of cost, we have two methods. One is the expected value method, and the second one is the present value of future cash flows. The expected value method is used when there is multiple outcomes from the occurrence of future events. We look at the expected value of these events and then we value our provision at its expected value. Then the present value method is used when there is only one most likely outcome from the future events. Like our court case in this situation, there is one likely outcome where the organization will lose the case. So if the organization loses the case, we estimate that we'll have to pay 300,000, and we are looking at the cash flow in about another 2 years. So I looked at the discounting factor at 10% cost of capital, which is 0.8264, and I have got the present value of the future cash flows, and I'll recognize the provision at that value. Now let's see how we accountants determine the probability of events. If the probability of occurrence is between 95% to 100%, we call it virtually certain. If the probability of occurrence is between 51% to 95%, we call it probable. If the probability of occurrence is between 5% to 50%, then we call it possible. But if it is between 0 to 5%, we call it a remote possibility. The table here will provide us the guidelines
to identify when should we keep a provision and when should we consider them as contingent assets and liabilities. Now, when you look at liabilities, if the probability of occurrence is above 50%, right? If the probability of occurrence is above 50%, that means there is a probable outflow of economic benefits, right? So at 51% to 95%, right? That is probable. Then 95% and above, that is called virtually certain. You're 100% sure you're going to win it, right? So at both these situations, if it is a liability, if you have to pay, if it's an outflow of economic benefits and the probability of it is occurring is either virtually certain or probable, then you need to keep a provision, right? Clear? But if it is possible, that means it is between 5 to 50%, then you disclose it in a note as a contingent liability, right? If it is between 5 to 50, that means the probability of occurring is possible, right? Therefore, you will consider it as a contingent liability and disclose it under the notes, right? If it is remote, that means the chances of you having to pay is less than 5%, it is between 0 to 5%, you can completely ignore it, right? But when it comes to contingent assets, you can only recognize it as a provision if you are virtually certain. That means the probability of you receiving, you winning the court case, right? The probability of you receiving economic benefits is about 95%, right? When you are virtually certain that you will receive the money, okay? But if it is probable, if it is between 50 to 95%, then you will not consider it as a provision, but you will disclose it in your notes as a contingent asset, right? Remember, under liabilities, if it is above 50%, you kept a provision. But when it comes to assets, it has to be virtually certain. That means it has to be above 95%, right? So if it is between 50% to 95%, then you disclose it as a note. Anything below 50%, you completely ignore it, right? If the probability of occurrence is below 50%, right, then you completely ignore it, right? Clear? Now let's look at the accounting treatments. At the initial recognition, we measure the provision at the present value of the future cash flows or the expected value. The double entries to record this transaction would be the provision expense account will get debited and your provision liability account will get credited. The subsequent measurement, we will have to unwind the discount. Now to unwind the discount, the double entry would be the finance cost account will get debited and the liability account will get credited. Let's see how do we do it. Now in 2019, we had a present value of 247,920. We're going to calculate the present value as at 2020. Right now we are going to use 1 year's discount factor at 10% because 1 year has already passed. So now the present value of the future cash flows is 272,730. So you see there is a change in this provision. Okay, so just like in a provision for doubtful debts, we account for the changes in the provision. Now there is a change of 24,810. This change is what we will be accounting for. So the double entries would be the finance cost will get debited by 24,810 and your liability account will get credited by 24,810. Let's look at the accounting treatment at the final settlement. And when you finally settle it, your liability is decreasing, therefore the liability account will get debited and you are using your cash or bank, so your bank or cash account will get credited. Before we conclude the video with the disclosure requirements of IAS 37, I got few bonus tips for you.
Now let's look at a onerous contract. A onerous contract is when you make a loss out of the contract. The unavoidable cost of completing the contract is going to exceed the economic benefits that you get from the contract. For example, let's say the economic benefit that you get from a contract is 500,000 and the cost of completing it is 600,000. So you are making a loss of 100,000. Now, for you to keep a provision on onerous contract, you need to look at two values. First, you need to look at the penalty that is payable. The second one is the cost of completing the contract. Out of these two values, you select the lowest one. So on screen, there are two values. There's a penalty of 400,000 and there's a cost of 300,000. So you select what? Correct. You select the cost of 300,000. Now, let's look at restructuring cost. Now, for restructuring cost, for you to keep a provision, IAS 37 requires you to satisfy two conditions. Those two conditions are that there should be a detailed formal plan on the restructuring process and there should be a valid expectation that the restructuring will take place. If those two conditions are met, then you can keep a provision for your restructuring cost. So now guys, let's look at the disclosure requirements of IAS 37. Now for each class of provision, a description of the following elements needs to be there. There should be a description about the nature of the provision. There should be a description about the timing of the provision. There should be a description about the associated uncertainties of the provision that is kept. There should be the assumptions that you are kept. And if there's any kind of a reimbursement of the obligation or the provision, right, you need to mention them as well. And then the second type of disclosures, what you're going to be looking at is, for each class of provisions, there should be a reconciliation of the opening balances of your provisions, the additions during the period, then any obligations that have been settled during that time period, any obligations that you have reversed because it doesn't meet the conditions that is required by IAS 37 anymore, then any unwinding that is being done, the discount rate at which you did the unwinding, then you will need to show the closing balances of your provisions under your disclosures or notes.
So this is going to be a wrap up for today's video. Those who are new to the channel, please subscribe and press on the bell button so that you do not miss on the upcoming videos. Please share this video with anyone who would benefit from it. Support the channel guys. Peace out.